Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. We begin in Hong Kong, where rescue workers are trying to extinguish a major fire at a high-rise apartment complex in the northern part of the city. At present, the death toll is 44, although hundreds of people are still missing. And according to the fire department, blazes in 4 of the buildings are under control. However, 3 buildings are still burning. Bloomberg's Minmin is on site.
I just want to tell you what it's like to be here, because the first thing you notice is the smell of the putrid smoke. And when the wind blows, I could feel the sting in my eye, because the buildings behind me are still billowing with smoke, and we are 16 hours into this fire, which started yesterday at 3 p.m. It was a level 3 fire at the time. It has upgraded within hours to a level 5, the highest severity, by 6:30 p.m. And if you can see, the buildings behind me, they are very close together, which is very typical of any, Hong Kong apartment residential estate. So that is one of the reasons why the fire was able to spread from one block to another. But another reason is because this entire estate is about 40 years old or so. It is a government subsidized residential housing unit, and it was going through heavy renovation. And you can see remnants of those bamboo scaffolding, again, very characteristic of Hong Kong as well. Now, typically, the fire wouldn't be spreading as fast as it did today, and the authorities were saying it was spreading at an unusual speed, and they had found polystyrene boards on the windows, and they suspect they have found materials that were substandard as well. So the green netting, some of the plastic sheetings, if they were compliant with Hong Kong standards, they would have to be fire resistant.
That's Bloomberg's Minmin. Now, Hong Kong police have arrested 3 people from an engineering firm on suspicion of manslaughter. At the same time, this fire has prompted renewed scrutiny of the city's use of bamboo scaffolding on major renovation projects. Let's turn to markets in the Asia Pacific, where equities, for the most part, are advancing after some gains on Wall Street. And we got perspective from Hartmut Issel. He is head of APAC Equities and Credit at UBS Wealth Management. Hartmut spoke with Bloomberg TV host Shery and Avril.
So Hartmut, talking first about the most important central bank in the world, right? The Fed and December being more or less baked in already. But we also have come quite far. Remember, around the time of October, December seemed like a done deal. So what extent is there this certainty? What is that going to mean for Asia?
Now, I think we have to assume, and we had on our side assumed all along also that December is coming, when we think at least another one for also the first quarter. For Asia, it's generally typically positive. Also, when the dollar comes a bit softer, right, the U.S. economy is doing okay. So, we will have the entire APAC region on attractive, with a couple of different markets that we highlight in particular.
Which ones in particular?
Yeah, I would mention 3 different drivers, so to speak, and they're all very different. That's why, that's also the beauty of the APAC region here, right? So you can diversify that pretty well. So you have the AI side. We would probably pick their China tech, right? Also come back a little bit. That looks very, very interesting.
As opposed to, say, South Korea, Taiwan, Japan.
Japan is for different reasons. I'd say Taiwan, South Korea. I mean, especially South Korea has run up quite a bit. But if it comes down a little bit, we would also consider that. But probably right now, if we compare these, especially on the AI side, probably the favorite right now is China Tech, and the other ones we have is value up programs. So 2 I would like to mention here is certainly you mentioned Japan, Avril. The other one is here our home Singapore. Right? And then you have some sort of laggards also from the earnings side, but also from the index side to some extent laggards, and that's India and Indonesia. So again, they have different drivers. Next year is going to look a lot better on earnings like it normally does. So you have 3 different drivers. Interesting region right now.
I want to turn to Japan, but first let me stay with China, because is it still appealing to you when you continue to see the U.S.-China trade tensions and you have the Pentagon continuing to add these companies to its blacklist?
Yeah, it's not the first time that we're seeing some noise happening around, in China or the China stocks as well. Like, look, I always take a step back on fundamentals, right? I mean, how many of these Chinese companies are really exporting anything significant to the U.S., right? So then you could argue they don't really, right? So these sort of maybe it's also part of a negotiation. I'm not saying we'll stop it here, but we have seen it before. It has never stopped really the Chinese stocks also from doing well, as long as their fundamentals are doing well. So I wouldn't overinterpret that part of the game.
Yeah, I mean, you have a point, right? We are seeing this bifurcation when it comes to tech supply chains anyway. So what does it matter if the U.S. continues to ban these companies? At the same time, for some of those Japanese names, if you see the bigger and sharper bifurcation of supply chains, what does it mean for the likes of Tokyo Electron that supply this equipment and cannot service their facilities in China, for example, or even the South Korean chip makers that cannot sell to Beijing?
That has been something that influenced a couple of companies, including, of course, also European ones, right? So it's a wide phenomenon. Oftentimes what we see, because the demand for, certainly on the AI side, but even beyond AI, right? So more traditional semiconductors, it's very, very strong right now. So what you sometimes see is that if something really happens on the China side with some restrictions, right, then you bake maybe a few quarters in where that takes an effect. But as long as the demand globally is that strong, right, it never really has held back the stock prices of these companies. And I don't see why it would be different this time.
For the drivers of Chinese tech in particular, what are you seeing in terms of valuations versus its global peers and the prospects of growth, especially since we've just come through the earnings season? We still have Meituan coming up, of course.
Yeah, that is interesting. I mean, one point I would highlight in particular, especially on the China side, is the cloud area of it, right? Because you have a bit like you had in the US with some similar names, I would say, right? So investors watching also e-commerce, etc. There's one thing you can do, but ultimately we know that everything eventually shifted towards cloud, or later on also AI. And again, I wouldn't see why it would necessarily be different, right? So if I look at the big China ones, especially those that have cloud businesses, right? We see them only in recent quarters, maybe the last about two quarters, the cloud growth really coming up. So why wouldn't I pay more than the sort of mid-single digit multiples on the earnings side that we're paying now? It's not difficult to make a case. It should be quite a bit higher.
But there is a sense of a double standard, right? If you look at some of the U.S. players, okay, strong cash flow, capex looks great, and when they spend more, they tend to get rewarded by investors. Sometimes that's not the case with the Chinese tech names. So what is your sense of what might shift the needle when it comes to global investors looking at Chinese tech stocks in particular?
I think one thing that is interesting, right, if you also look at how long, the period of, AI investments, thinking about AI has lasted, right? In the US, you could say easily maybe give and take 3 years, right? China, probably more like 1 year, right? So that alone means that China, right, and everything that should follow is a bit earlier in its stage yet than the US already is. So that alone, in my view, is something that investors should keep in mind.
It's been really interesting, Hartmut, how sentiment has turned in recent days after the tech sell-off earlier in the month, right? And now it seems that at the driver's seat is also monetary policy with more dovish Fed speak. What does it mean for Asian markets?
If I look a bit further out, right, for the landscape, let's say we get a bit softer next year GDP growth, etc., than perhaps is expected right now, right? That gives a lot of the Asian central bank a lot more also room to cut even further than we already think they would still go to some extent. So it buffers the downside on the equity side.
What does this mean for Asia local credit next year if growth, to your point about it being quite resilient, but we also have maybe some of these central banks have run up into the limits of how much easing they can do?
Yeah. We see also the bit longer term bond yields coming from certainly the US, also going a bit lower from here, right? And then with the dollar, especially maybe over the next 6 months or so, also being a bit softer. That means here for APAC, we prefer the IG side, but we also prefer, naturally, I would almost say, the local FX side on the bond side. These two are the ones we really like.
That was Hartmut Issel, head of APAC Equities and Credit at UBS Wealth Management. He was speaking with Bloomberg TV host Shery and Avril Hong here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. The U.S. equity market advanced in the last session on rising expectations for Fed rate cuts. We had the S&P gaining ground for a fourth straight session, with a gain of 0.7%. Unsurprisingly, trading was light in front of the Thanksgiving Day holiday. Volume in the S&P was about 23% below the 30-day average. And volatility seemed to take a breather. We had the VIX falling more than 7%, closing just above 17. For a closer look at the price action, I'm joined by Patrick Kennedy. He is founding partner at All Source Investment Management. Patrick, thanks for being here. What is your sense of what the market is trying to understand at present?
I think there's two big risks that the market is focused on right now. One is obviously valuation. So valuation is very frothy when you look at history. Things like the Buffett indicator are hitting an all-time high, 2 standard deviations above where they usually are. So the Buffett indicator is just GDP versus what the stock market value is, right? Very simple indicator, but a powerful one. And then the other is rates. So I think we're getting more clarity that there'll be cuts coming. After the last meeting, we had a lot of Fed chairs saying that, it wasn't necessarily a certainty that we would be getting a cut in December. I think the odds are now favoring a cut and potentially a couple more in the second half of next year. But if that story falls apart, if all of a sudden, we're pausing for longer, we view that as a pretty big risk to market, especially with where valuations currently are.
So we had the Beige Book today from the Fed. And as a part of this report, multiple districts, including New York, Atlanta, Minneapolis on the list, they all reported spending among higher income consumers was resilient. However, low and middle income households are tightening the belt. This goes to this K-shaped economy that we've been talking about. It doesn't seem to be changing at all, does it?
It doesn't. It's the story of two economies. And to your point, Doug, I think the folks on the lower half of the income spectrum are getting hit harder from things like tariffs, right, and inflation. So you got to think about what that consumer has been through over the past 5 years. They've seen rates go from 2% to, well above 5%, and now back down to around 4%, right? But they've also seen skyrocketing prices in fuel, food, you name it. So they've been through quite a lot when you just look at their wallet, right? Now, the top half of the income spectrum can weather things like that. It's not as big of a blow to them. But that's not the case for lower income households. So we have to see how that plays out for more cyclical names, things like retailers and such.
So if expectations are calling for a Fed rate cut in December and many more in the year ahead, maybe as many as 3 for 2026, I'm curious as to get your take on the effectiveness of lower rates in helping to address this K-shaped economy.
That's a very tough question. I think that, if you have lower rates, there's a reverberation across markets. I don't think that that's the only thing that we need to do in order to correct that. It's a much more difficult problem to solve, in my opinion. One, you need strong earnings to come through so you can continue to have job growth, income growth, and that sort of thing. And I think the S&P is now pricing in around 14% on earnings growth next year, which is largely due to AI. I think the big story around earnings growth next year is that the bottom 493 need to deliver, right? So everyone knows that the Mag 7 is doing very well. They're profiting from AI. You're already seeing the underlying impact of their balance sheet, cash flow, so on and so forth. Where we haven't seen that is the 493, the bottom 493, right? And the expectation is that in 26, we see a broadening throughout those names, which will help those lower income households, right? If we don't see a broadening within those 493, that's a big risk for markets. And in fact, our view is, ironically, if we don't see a broadening within the 493, what's even more at risk than those names decreasing in value is the Mag 7 themselves, because of the concentration within those names. So in the S&P, as I think it's over 30% now within the Mag 7, if all of a sudden that thesis doesn't come to play where we see this broadening within the market and the market is sold off, it's going to hit the heavy concentrated names, which is the Mag 7.
So we know that the equity market has been challenged recently with a fair amount of skepticism when it comes to the AI trade, especially where mega cap tech is concerned. Trading has been pretty choppy over the last couple of weeks, although now it seems as if the market has found some solid footing. Does that necessarily mean all questions have been answered, particularly as we look ahead to the new year?
So I see a definite split on the street when it comes to your viewpoint for next year, right? I mean, at the beginning of 2025, there's a lot of bullishness out there. That has very much changed at the end of 25, where you see almost an equal amount of bears. And I think the big inflection point for next year is, does AI monetize in the way we think it will, right? If it does, great. The bulls win that argument and the bull market can continue as long as rate cuts come along with that. If we don't see monetization next year, I think that's when the chickens come home to roost, so to speak. I think that next year is that inflection point, the show me market, so to speak, where AI truly needs to show its benefits, because now we've been rallying on 3 years of this news. So if we don't see the underlying impacts hit to earnings, I think that investors aren't going to give as much rope as they gave this year, right? And we'll sell that news. So because of that, we're a little more cautious next year on that story, and we want to see how it plays out.
How are you feeling about markets offshore right now, foreign markets, particularly those in Asia?
EM has had a phenomenal year, right? A banner year. We see momentum going into next year. I think obviously if the U.S. market gets hit, if the U.S. market sneezes, everyone else catches a cold, so to speak, right? But I do think the story can continue in EM next year as long as rates come down. I think a lot of that has to do with the story of, hey, rates have peaked. We're now seeing rates come down, or at least the expectation of rate cuts coming. And therefore, EM stocks should continue to do well. So a lot of momentum has been built up over there, and I think it's going to be tough to kill that within the next 6 months.
So we've seen the dollar hold up pretty well recently, even though there's been a lot of conversation about impending Fed rate cuts. And if the dollar continues to remain firm, yes, markets in Asia may benefit. But I'm wondering about the point where the dollar's fortunes begin to change. Is that something you've thought about?
It's been a strange macro story, Doug. I mean, look at gold, for example. Gold has rallied with stocks. So I think, one of the things that investors were concerned about is usually the gold market will sniff something out prior to the equity markets, and all of a sudden you see the gold markets rip higher. It's definitely cause for, I won't say concern, but pause, right? So all year we've seen gold rally with stocks. I think a lot of that has to do with concern around valuations, concern around debt, central banks, so on and so forth. But typically, you don't see as high of a correlation between gold and the stock market. What we're really interested in seeing is next time there's a big pullback in stocks, if there's also a pullback within gold, right? So we own it as a hedge, one, and then two, obviously, capital appreciation. But if all of a sudden that hedge story falls apart, we're really going to have to rethink our thesis on that.
Okay, Patrick, we'll leave it there. Always a pleasure. Happy Thanksgiving to you. Patrick Kennedy is founding partner at All Source Investment Management, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.